thanks. Yeah, thanks for having me. This paper is joint work with Joey Engelberg and Will Mullins, and this is a brand new paper. So we're really keen to get people's feedback. We think we're up to something really interesting, but definitely this is a situation where we're really eager to get ideas. So excited about it. So just a little background for what we're studying here. There's this phenomenon in financial markets that there's an enormous amount of trading in financial markets. So here's just kind of a plot: yearly trading volume as a percent of GDP. You can see it regularly exceeds gross domestic product in the United States. This is something that is sort of well known to be puzzling. And it's puzzling, especially if you sort of look at sort of the classical models that we have in finance that motivate trading. You know, models with private information really can't even get any traction for trading. There's even a no trade theorem without additional ingredients. You can have different information, but if you don't have like some other ingredient, you don't get trading. Noise traders, liquidity shocks, portfolio rebalancing can generate trading, but that just doesn't quite seem to be enough. And to quote John Cochran from a really interesting blog post, he's called this the great unsolved problem of financial economics. One popular explanation for high trading volume, however, is disagreement. And there's a classical paper by Harris and Raviv, but if you the more you dig into this literature, the more it begs some fundamental questions. In particular, one big question that you should have when reading this literature is, well, what keeps people in disagreement? Just kind of point to a very well-documented result in this literature. Most volume is around public news announcements when rational updating based on new information should dictate convergence in beliefs. Yet we see divergence in beliefs around this arrival of new information. There are a couple of potential explanations, really classes of these out there. People have different models, so they see the same information, but they interpret it differently, or they have different information. And the way this is conceptualized broadly in the literature is that it's really the same information that percolates slowly across individuals in the marketplace. But even these kind of beg the question, well, what keeps people having this sort of different information? Why is it so slowly percolating? Why do they have different models in the first place? So in this paper, we think we make some progress on this. And way to think about our paper is that we're proposing a model, really not a model, but evidence for different information in the form of what we call echo chambers, or what the literature calls echo chambers. So an echo chamber is going to turn out to be a way that you can sort of think about this different information being sustained over sort of longer periods of time. So to give you an idea of what an echo chamber is, so here's just kind of a group of people. Their differences of opinions are indicated by their color. Some people are red, some people are blue. In the literature, the classic example is that the red people tend to watch one type of program, call it Fox News, and the blue people tend to watch another type of program called MSNBC. And the idea is that they source their information from sort of different sources, it's going to be harder for belief updating to lead to convergence in beliefs. So in a financial context, think about red people being bullish and blue people being bearish. What an echo chamber in sentiment would look like, and this is what kind of our paper sort of points to, is that red people who are initially bullish about a particular stock, are going to tend to overconsume bullish information, and blue people are going to tend to consume bearish information. So that's kind of the big picture of what's out there. Now, this if you sort of look in the literature about like where is this idea, well, this idea relates to a really deep literature in psychology on what's called selective exposure theory. And if you sort of quote from that, you can see that individuals prefer exposure to arguments that support their position over supporting other positions. There's evidence brought outside of financial markets for this, Republicans versus Democrats, Christians versus non-Christians, smokers versus non-smokers. But there really is a lack of evidence within financial context. Here we see that people choose information that confirms their own belief. Now, I use that word confirms because this idea relates to something that we do have in finance, which is confirmation bias. So let's kind of make sure that we fix ideas about like sort of where confirmation bias fits in versus where selective exposure is. You know, confirmation bias is this very well-known tendency in psychology to either seek or interpret information in line with one's priors. And the key is that you want to sort of process. It's more in the literature. If you read the papers in this literature, it's about processing the information to bring your conclusions in line with the priors. Selective exposure in this broader literature is really about seeking information in a biased fashion. A lot of it has to do with bringing it in line with your priors, but you can have other biases that lead to only seeing a piece of the overall informational puzzle. So just a nice Venn diagram to show where we fit in. Selective exposure and confirmation bias, where they intersect, is biased sourcing of information in support of one's priors. There's plenty of sort of knowledge that individuals interpret information in a way that tends to confirm their priors. We're going to be focusing, drawing the line between where do you get your information versus interpreting that information, and drawing that line within a financial context brings the focus to echo chambers. So null hypothesis, you may be kind of wondering this, well, is it surprising to see echo chambers in a financial context? We emphatically think yes, this would be a surprising phenomenon. In particular, in markets, forming correct beliefs is valuable. And it doesn't matter if the information confirms your prior or disconfirms your prior. If it's value relevant, you should want to know it. And so sourcing in a sort of a way that is sort of motivated by your prior belief is bound to have a cost. This is not true for settings for most other settings where echo chambers have been studied. In particular, there's no immediate personal incentive to be correct in beliefs about politics or beliefs about science, religion, or branded pickup trick. So we think that sort of showing this in a financial context, there's a higher bar, but it also makes it a bit more interesting to find. So what do we do? What we do is we study a setting in which we can see information sourcing decisions, namely the decision to follow another user and place their posts into your newsfeed. So this is StockTwits. It's like Twitter for stocks. And we're going to be able to study about 300,000 users who contribute more than 25 million posts that are self-labeled as bearish versus bullish. Then what we're going to do is we're going to see if the people who declare as bullish or bearish about a particular stock then tend to follow like-minded people and place them into their newsfeed. Following someone on StockTwits is a decision to expose oneself to their information. That would be showing sort of evidence, at least on StockTwits, that there was this notion of an echo chamber. And so the final thing that we do, and I think that it's a really important thing that we do, is to examine whether the presence or absence or extent of this echo chamber behavior is related to the extent of trading in these stocks, the actual trading in the marketplace. Sort of gives us, I think, a linchpin that sort of allows us to say, well, how much does this kind of behavior actually translate into actual market behavior? So what do we find? Well, number one, we find strong echo chamber effects. Self-described bulls are 5 times more likely to follow a user with a bullish view of the same stock than self-described bears. And if we look at the bearish side, it's symmetric. So we see that bears are more likely to follow other bears. We see similar results with their general newsfeed and likes. So think about it this way, they actually seem to be exposed to differences in this information. Over a 50-day period, I think we get someone who's a declared bull sees 70 more bullish messages and 16 versus 16 fewer bearish messages over the next 50 days. It's sort of significant difference in information exposure. We see sort of interesting heterogeneity. Number one, it remains true for professional investors on the platform, even though it's a bit stronger for novices. And the second thing is that when we look at points of arrival of news, we see that people more strongly select into confirmatory information. And finally, I sort of previewed this, we look at trading volume, we find that echo chamber behavior is more strongly associated with trading volume. So I decided to put in pictures of some of the organizers to sort of ping for if there's some questions. So just wanted to sort of pause and see if there are questions before we go into some more details, a stylized example, et cetera, to highlight things.
Okay, you chose to stop on that slide intentionally, I think.
I did.
So we've got a few questions. Given all public information, selective exposure could be endogenous. Does your paper also address this?
So that's a great question in the sense that we are excited to actually look at this endogeneity. We want to actually document the degree to which people endogenously select into this. Now, what do we mean by endogenous? I think we think that this is a confirming of their priors. We're more documenting, is this do people select into this? Now, that I think is a focus on the selection effect. We're not saying that people are sort of treated by their sort of prior belief, but what do people who have this prior belief do when they source information?
Okay, who is responsible for what fraction of trading volume? Institutional investors, retail investors, algorithmic trading?
I mean, I think certainly, I think the implicit question here is the StockTwits data all about retail investors, or is it just capturing sort of these other components? I certainly think that these other components of disagreement are trading volume are important, and the degree to which StockTwits is going to then predict this or associate with this, and this behavior on StockTwits does. Suggests either sort of one of two things. One is that the sort of the echo chambering behavior on this is sort of generating a broader reaction. The other is that we have a broader set of people than maybe your prior. That there actually are professionals on this network, and their beliefs are actually capturing sort of a broader component than that.
Okay, have you controlled for traders with different ex-ante positions? Two investors may take exposure to the same information and interpret it similarly, but one might want to sell to book profit, while the other might want to enter into a new position.
That's a super interesting question. We have some tests where we actually look at people who look like they said they just bought. We haven't incorporated those into the paper yet because it's just taken a bit to kind of get that in there. We think we have quite a bit of sort of interesting and thought-provoking findings once we get into them.
So there's a related, I guess, clarifying question. Yeah. Is there a link between individual tweets and individual trades?
So we think that when I looked at, so I have a previous paper with Marina Niesner where we sort of track performance of portfolios that follow professionals, novices, and intermediates as just kind of a validation. It sort of looks like at least the fact that this seems to be predictive for professionals and predictive not doing well for novices, that it's not inconceivable that they're actually taking these positions. At the same time, there's a subset where users actually say, I just bought this. And so we think that there is some correlation with this. But yeah, it's sort of, I have a few slides in the near future that will sort of describe some of the incentives to post.
Another question is StockTwits used to gather information or disseminate information? Is following another user a way to promote the views to more people, perhaps to try to manipulate prices?
So if one follows another user, there's no reciprocal thing. So it doesn't necessarily get your information into their newsfeed. All that it does is that it exposes you to what they post. Now that certainly there's sort of the dual, like, I'm collecting information as well as I'm disseminating information. But the following decision that we focus on is the decision to place some other user's tweets and their sentiment and their content into my newsfeed.
Okay, a couple more questions. When is the self-declaration of bear versus bull made? Is it possible that I choose to become a bull after reading the posts of the bulls, which I find more convincing?
So we do this with timing. I think I'll once I get into the data, we can. I think I'll defer sort of a more complete answer once we.
Okay, there's another question. I think we'll wait on that too.
Okay, great. So just to give you an example of kind of what we sort of view as going on here. Here's two users, and this is an extreme example of what could be going on. This is, but it kind of sets the idea of what selective exposure looks like on StockTwits. So two users post about Tesla November 14th, 2018. EV is the future is bullish, whereas Dr. Burry is bearish. EV is the future talks about how it looks like Tesla Power Pack project could lead to sort of more opportunity. So, and whereas Dr. Burry calls this a Tesla fraud. See, they disagree. But what we do in this paper isn't just about like the disagreement between the statements. It's really about like, well, what does EV is the future? How does EV is the future, a bull on Tesla? What kind of information is EV is the future exposed to versus what kind of information is Dr. Burry exposed to? So EV is the future sees, as it turns out, 45 bullish posts and 0 bearish posts. And you can see that on the following day, EV is the future sees quite a bit of informative bullish posts. You can see Tesla is about to rip. Here's a link that sort of points to that. Musk acquired trucking capacity to ensure Model 3 delivery by December 31st. Bears, you're going to lose. Here's some arguments that we consider idiotic. So you can see there's a bit of arguing there. Tesla going to be glorious, and so on. Kind of get a sense of like what kind of information EV is the future has chosen to expose himself to. Whereas Dr. Burry, who's a bear, the following day newsfeed on the exact same day is completely different. 12 bearish and 0 bullish posts. So you can see here, here, caution, folks, we're going to see a correction. Pray for the NASDAQ. This will take some intervention from the Lord and Savior Elon Musk. Look, they're looking at some sort of different kind of pieces of information. You see, they only sold 20,000 vehicles last month, and you sort of see that on and on that there's really a bearish perspective in Dr. Burry's newsfeed, posted by the people that Dr. Burry has chosen to follow. So you can see that they are selectively exposed to very different information feeds, and this is the type of thing that we want to sort of document, is that these choices are really pervasive, and try to show you this in a way that it's not just that they're reacting to the same news. So here, a little bit more about StockTwits to kind of get into our design. We're going to focus on the data from 2013 to 2019. We're going to restrict to symbol IDs. These are stocks and other assets that people can trade that have at least 2,000 messages. This gives us about 1,039 assets, 906 of which are stocks. We also had things like Bitcoin or the SPY ETF. And what we're going to do is we're only going to keep single symbol sentiment stamp messages, so we can then say that the individual is bullish about Tesla, or the individual is bearish about Bitcoin. We remove robot users who post just a bunch of sort of a bunch of tweets in a just kind of spam thing. And after we do that, we have about 300,000 users with about 25 million sentiment stamp messages about particular symbols. Rolling this up to the symbol user day level, which is going to be our main unit of analysis, we have 11 million observations. So what can I give you an idea of what this looks like? On StockTwits, it looks like Twitter. You can sort of type something in. There's a little slider that will click over to bear or click over to bull if you so choose. And you can see here's an example. Todd Sullivan is bullish about this TPL, which is a large landowner in the Permian. So we would be able to sort of classify what day this was. This was on February 1st in 2020. And we're able to, we can tell kind of the precise time. So in our data set, we can see that here, this is a declaration that on that day that Todd Sullivan is a bull on TPL. And we can then sort of link this to other declarations and other folks that Todd Sullivan follows. In addition, we have information from the user profile. So we can see that Todd Sullivan is a value investor who's a long-term investor. He's a professional. He follows 177 people. We can see the precise timing of when he made those choices. He has 108,000 people who follow him. It turns out to be a prominent person who writes off of StockTwits, so we can actually see sort of what he looks like, what kind of motivates him a bit. And it turns out that he's actually a pretty good example of someone that he writes on StockTwits in order to sort of gain a reputation. And so his incentive is to sort of post information on StockTwits to sort of build that reputation, and he markets that. So beyond this, like, I think there were some questions about, like, well, can we use this StockTwits sentiment as actually an honest declaration of how people feel? There are a couple of features of StockTwits that help with this. Number one, by design, StockTwits tries to make it so that users want to be right about their opinions. Users cannot delete posts after the fact. Most post under their real name in order to build a reputation, and this is especially true for professionals, and we can restrict attention just to professionals in our tests, which is a useful thing that we'll be able, that is helpful here. Sort of in addition, in prior work with Marina Niesner, we showed sort of several facts about sort of the timing of these sentiment declarations. One, we see that sentiment spikes when it should around positive earnings news. The other one I mentioned in response to a question, professional sentiment outperforms novice sentiment. So it seems like actually this expertise seems to relate a bit to the sort of knowing what's going on and sort of at least being able to pick up on risk factors. And message posting and sentiment relates to trading at the stock day level. And we saw that sort of in our previous work. So kind of given that kind of data description, I've seen kind of the orange thing pop a few times. Should pause for some questions.
Okay, yeah, so we have quite a few questions. Let me think here about the right order. So a question you just sort of hinted at here, do you know the percentage of StockTwits that are by true institutional investors, for example, pension and investment managers who control a high percentage of trading volume?
So, a lot of the professionals, I wouldn't say are institutional investors who they themselves control trading volume. They tend to be people who manage wealth. But I don't think that that's like necessarily like pension investors or like people who are at the top or those are necessarily posting opinions on here.
Okay. Some retail investors consider trading as entertainment. For example, Dorn and Stengmuller, 2009. If this is the case, could we think of selective exposure as a way to increase one's utility from forming a community, having people agree with their views per se, rather than just gathering information for future trades? Put differently, if someone tweets a lot and trades relatively little, they could still be happy doing this.
So yeah, I think if you also look at the literature sort of surrounding that, it's a pretty costly form of entertainment. I think, yeah, I mean, I'm aware of the Dorn-Sang-Miller work on trading as entertainment. There's also a nice trading as gambling paper. I think from the standpoint of are they doing this for entertainment versus sourcing information? It's, I mean, at least somewhat possible. It is at least an artifact of their choice that they're receiving this stream of information, and they're doing it in a way that seems to be biased toward their priors, which is the next bit.
Okay, a question, or are you assuming that this is all the information to which they're exposed?
No. I think we're assuming that this is when we go into the tests, we're going to say that I think the way that I've conceptualized this is that this is like a subset of the information that they have, but like, I mean, a subset could be a nice sample or a sort of a biased sample. I think that it's probably a reasonable picture of how they collect information in other domains, but I think like, to the extent that that's true, you're going to want to see this related to actual trading volume, not just on the platform, and that's why we have the volume tests.
Okay, a clarifying question about the news feed. Does that consist of what the user selects after seeing it, or do they show whatever the user sees or clicks? I guess maybe what is the news feed?
So news feed would just be like the posts of the people whom you follow. That those get dumped into your news feed. Now, you may sort of be asking this question. Implicit in this question is, do they actually see this information or do they not? That's one of the reasons why we also look at whether people like bearish and bullish posts after they declare as being bearish versus bullish, or whether actually their newsfeed what's in their newsfeed has that information. We're looking for other ways to sort of see that they actually interact with this sort of differential information exposure.
Okay, we've got a few questions that are about results.
Okay. Yeah, we'll get into the results soon.
Okay. I think there's one that I'm going to ask now.
Okay.
Probably more people read StockTwits than post on StockTwits. However, I think all the people in your sample are probably people who post on StockTwits. Presumably the people who post are promoters of information rather than consumers of information. Why else would they post? If so, how can you know that the average StockTwits reader is selecting stories that support their view?
So people who post are, yeah, they're both, they can also consume information. So yeah, I mean, I think we may have to think about this in terms a little bit more about like what selecting on people who actually do post on StockTwits versus just looking at what decisions people follow. Our tests don't actually, yeah, so sorry, let me backtrack. Our tests do not actually restrict on whether they post. Our main tests are about, do you follow? You do have to declare as bullish versus bearish, and so that sort of difference at some point you do have to make some kind of post, but you don't have to be an active poster. And so we'll have one split about whether you post a lot versus a little, and I think that might get a little bit at that question. That's an interesting question. It's something that we may need to sort of think about a little bit more about. Like, is there a selection into people who produce information versus just consume?
Okay, there are 3 more questions which I think might be better waiting.
Okay, great. Yeah, thank you. Yeah, thanks for all the questions. Really helpful. So one of the things that you might sort of be wondering is, like, if I declare as a bull for now, I mean, couldn't I change my mind? Well, empirically, as when we look at this, someone declares as a bull on date 0. Like about 80% of messages are bullish overall, but as someone declares as a bull on day 0, it turns out that it's really persistent that they're still a bull 50 days later. So that's that persistence is quite striking. It's also striking also on the bearish side, and you can see that if you have an unconditional likelihood of declaring as a bear of 20%, the sort of the overall likelihood in the 50 days following a bear declaration that you're still bearish about that same stock is actually incredibly high. So this persistence is helpful for us in a couple of reasons. One is our empirical design is going to try to tag people as a bull about a particular stock or a bear about a particular stock. But if they change their mind subsequently, it doesn't really make sense to say they're following decisions sort of in the next few days, the next week, the next month, like that those following decisions were sort of made in confirmation of that prior, if they had already changed their mind. In addition, we need to be able to classify the people who are being followed. And so the people who are being followed it's also useful that this is a persistent information source that you're signing up for. And so if you follow someone who's a Tesla bull, it's useful to know that they're going to be a Tesla bull more likely into the future, and the same thing on the bearish side. So this persistence is sort of a useful but necessary condition for the strategy that we're going to take. So to give you an idea of our strategy, what we're going to our sort of core observation is to follow another user is to sign up for their information feed. You see their future posts. And so from StockTwits, we have a timestamp when each user ID chooses to follow another. So we can see these following decisions relative to sort of these declarations of being bearish versus bullish. So I'm going to show you some graphical evidence, and then I'll show you some regression evidence that sort of pins down that variation a bit more finely. Maybe that will help satisfy that endogeneity question from earlier, but it'll at least limit the number of potential explanations. So in the following figures, what we're going to do in the following analysis, we'll identify self-declared bulls or bears about a stock on date 0. Think of it as the event. And then what we'll do is we'll accumulate how many follows of bulls versus bears happen in event time up to 50 days. So a user is a bull on date T if the user stamps the message as bullish versus bearish on that stock, stock S on date T. So we're going to focus on bullishness about a particular stock. And so this strategy is akin to seeing someone declare themselves as Republican or Democrat today, and then subsequently seeing, well, do you set your DVR to record Hannity versus watching Maddow tomorrow? And we're going to sort of look at these information sourcing decisions, the choices of whom to follow. So just to kind of give you this in a nice picture, for declared bulls, so this is the likelihood of new follows per declaration. You can see that a declared bull is about 5 times, so it follows 5 times more new bulls than a declared bear does. So you can see that this sort of information sourcing is actually pretty strikingly different, bulls versus bears. Now you may sort of think, well, does this have to do with like composition? If there are more bulls versus bears on StockTwits, but if you look at what happens on the bearish side, the choosing to follow bears, you see that declared bears follow other declared bears at a higher rate than the declared bulls. Of course, these likelihoods are lower than the declared bull because there are more bulls to follow than there are bears to follow. But the ratio really it's almost spot on. It's about 5 times the rate at which declared bears follow like-minded declared bears than do declared bulls. So I promised a regression specification. So what we're going to do here is we're going to look at whether an individual follows bullish individuals in a period following a declaration of being bullish. So here, declared bull is an indicator for whether a user declared as bullish about a stock on date T, called date T, the focal date, that event date. And we'll then look at it as an outcome, an indicator for whether the number of bull follows is greater than the number of bear follows, net of unfollows, between that declaration date and some date in the future. So sort of our first specification will just be 1 day forward, follows on that next day, but we'll also look up to 5 days, and we have on our to-do list to sort of extend this this window of following, just to sort of bring it more in line with the sort of the window of time we looked at in the graphs. Importantly, because our observations are at the individual stock date level, we're going to be able to include a really rich set of fixed effects. One is we'll be able to include individual fixed effects to absorb person level heterogeneity, people who just tend to follow more of other individuals, or people who tend to be more optimistic. We're going to kind of absorb kind of any kind of time invariant aspects of that. And we know that people are different that way. But interestingly, because we have this, this stock day user level information, we're actually able to include stock day fixed effects. So what that allows us to do is it allows us to essentially make the comparison between two individuals who declare as bullish versus bearish about the same stock on the same day, and we can look at their differential following behavior. Now, combined with just kind of the qualitative graphical evidence that I just showed, hopefully this will kind of provide you, rule out a lot of alternative ideas, like maybe this is just attention to the stock or news. And so this, so stock day fixed effects, we think absorbs anything that's kind of time varying about what's going on in a firm. So here, when we do this regression, we multiply the dependent variable by 100. So these are percentage change interpretation. And what we see is actually pretty large effect size across specifications relative to the mean number of percent of follows of bullish versus bearish information. We see that a declared bulls relative to the baseline see an increase in their following of bulls of between 20 to 40% more than the baseline, relative to sort of a declared bear. When you may sort of think, okay, these percentages are 0.6% relative to the baseline is pretty large, 1.7% relative to the baseline is pretty large. But one other thing we can do to sort of get a sense of the sort of the magnitude of this is conditional actually on new follows. And you see when you condition on new follows, you get something like you're 20% more likely to follow a bull versus a bear if you're a declared bull. And so that is really actually a striking magnitude in the degree to which declared bulls selectively expose themselves to the news feeds of other declared bulls. And as I mentioned, the day symbol fixed effects rule out a lot of sort of ideas you might have in your mind that this is just market level attention, or that this is just news, or that something happened to this firm. This is the difference between someone who declared as bull versus declaring as bear on the same day. And we're sweeping out that individual level heterogeneity as well. We also do a trick to try to think about, well, what do stocks that have sort of stronger bearish echo chambers versus bullish echo chambers look like? And what we can do is we can condition on whether someone was a declared bear, and then look at their sort of following with a stock fixed effect. And it turns out that the stock fixed effect in that regression captures the degree to which, after someone declares as a bear, that you see more selective exposure for individuals who declared in that particular stock or symbol. And what we see is actually pretty interesting. We see Tesla, Bitcoin, Beyond Meat tend to show up in this. These tend to be like sustained bull runs, at least within our or strikingly striking bull runs where bearish individuals have to really seek to find other bearish individuals. It seems like distant history, but our sample actually ends before sort of the recent turbulence in the stock market. I think the S&P 500 was on a really long bull run, and it's one of our bearish echo chambers. When we look at bullish echo chambers, these tend to be kind of one-offs where like medical technologies, like a specific medical technology idea, and there's just like not really much going on. And so someone who's bullish about Delcath Systems or Citrix Corporation is really kind of on their own, and so they need to go find some other bulls to kind of help support that. And so you see that these tend to be the more bullish echo chambers. We thought this was sort of interesting descriptive evidence, but it is also consistent with this idea that it seems like these prior beliefs are being supported by these information choices. One other thing to kind of help support that kind of main result I'm following, we had some questions that were sort of anticipating this, like does their newsfeed actually reflect these differential choices, or do they actually seem to consume this? We have two cuts at this. One is we actually look at like what are the posts of the people who what is there an asymmetry in the sentiment in the news feeds, and you see that actually bulls see a lot more bullish information, or at least bullish information is posted by the people they've chosen to follow. And similarly, bulls tend to like more bullish posts about that same stock in the subsequent time. Now you might say, well, that's just sort of rehashing the following, the preference, the initial preference in the first place, but they reveal that the user actually saw the message and interacted with it. So there's the evidence of likes we think of as like indirect evidence of consuming the information, not just kind of rehashing the sort of the following decision as well. So we see, so actually kind of in both cases, we kind of repeat those graphs, we repeat those regressions. We find incredibly strong evidence that there's selective exposure through the following decision, that it manifests in different news feeds, different messages that people see, and that these individuals who made these initial declarations actually interact with these posts in a differential way. So I think this is a good time to pause for more questions.
Okay, so the first question, this was asked quite a while back. Do more experienced or even better, more accurate on average traders herd less or more?
They heard less. You're anticipating my next result. I should just point you to this. You're sort of at one question you're asking is, do amateurs, is this an amateur behavior, or is this selective exposure? I think, experience tends to make biases sort of less pronounced. I think that's like the broader behavioral literature suggests that. If we look at novice, intermediate, professional, you can see that actually is the case, that professionals exhibit this somewhat less. On a baseline amount of selective exposure, 1.8 percentage points, they chop off about a third of that, but they're still exhibiting a significant amount of selective exposure. That's a great question.
Okay, second, does the volume of tweets co-move? When there's a high volume of bullish tweets, is there also a larger response by bears? Kind of a tug of war to influence general opinion.
That's not something that we've looked at, like whether there's like I think it'd be interesting to look at, but it's not something we've looked at. When we get to the volume tests, we account pretty flexibly for the amount of attention and amount of sort of the tweet volume. If you think that like tweet volume is sort of driving the selective exposure, we're sweeping out anything at the stock day level. So anything that's happening at the stock day level, that's not sort of driving the differential exposure choices that people are making. They could choose to follow the bulls or the bears.
Okay, could the ratio of the posts that one likes versus all the posts in their feed also be informative? The ones that you choose to believe out of all the information you're exposed to is purely endogenous in a way.
No, that'd be interesting. Yeah, I'd like to, I should think about that. That's a nice comment. Thank you.
How does learning from past twits, and in parentheses position, affect their future position?
In terms of like so how does learning from past twits position affect their future position? I think if you sort of remember back to the sort of the prior, like that first plot that I presented, if you declare as a bear or a bull, you're very likely to continue being a bear versus a bull. I mean, that's more just an empirical fact. Now, is that how much is learning? I don't know if I couch it as necessarily learning. I think we're seeing people tend to select uh, uh, information sources that confirm what they already stated about these stocks.
Okay,
I have to think about that more.
we've got a couple of questions here that are related to each other. The first, let me just read both of them. Do all StockTwits have to have a declared bear or bull flag? If not, can these StockTwits without flags be more bullish or bearish? Is there any bias in results between the declared versus non-declared bulls and bears? Okay, the other one is the majority of tweets do not have a bear bull flag. Estimation of sentiment leads to similar bull bear split.
Answer, not a question.
Yeah, no, that was more of an answer. Yeah, that was a helpful answer because it was something that we had done in our previous paper. So like, yeah, the majority of tweets aren't classified. We're focusing on the ones that are. It is a subset that we're looking at.
Okay, but there is a statement at the end. I'm actually in favor of a third uncertain or undeclared category for sentiment analysis of StockTwits.
Okay. No, I think yeah, it's a choice that we made at the outset, was to focus on the sentiment stamped messages. I think it is potentially something we could do, is look at like, is in this other category where people sort of declare versus not. It sort of looked like they, when we did our analysis of this and actually classified the tweets in the paper with Marina, that the unclassified ones were either bearish or bullish, but you had to kind of infer it from the text. We wanted to take that kind of inference bit off of the table, so that we could just focus on declarations. The other reason to do that in our context is that for someone who's sort of choosing to follow a bull versus a bear, it's sort of much more salient or prominent if someone says that they're bearish or bullish about that particular stock. And so we wanted to have those declarations be how we labeled these individuals. So yeah, I think it's incorporating the sort of the undeclared. We might be able to look at how undeclared individuals follow others, but I think we'd have to be careful about whether we would symmetrically then treat the information sources that people follow. It's not obvious to me, and so focusing on the subset, we felt like we could get kind of at least a cleaner picture of it. But like, it's worth thinking about this some more. So yeah, thanks for the comments.
Okay, a few more. Do you also consider stock characteristics? I was wondering if the selective exposure is stronger for certain stocks, for example, past winners and losers.
So yeah, the past winners and losers, that's something that we haven't done that much. We had a version of the next table after this experience table where we looked at returns, and it was more about the returns at the time, not the returns from the time of declaration. One of the things that we're working on is that kind of text classification of where people actually said that they just bought or just sold, and then we're tracking those individuals over time with respect to what their return would have been. So we could then think about past losers versus past winners. We think that'd be an interesting source of heterogeneity but not necessarily affect like the core result. It's a nice idea.
Okay, two more questions. The first may be related to a couple questions ago. For echo chamber effect, shouldn't following have an effect beyond individual bullish attitude? Is it possible to measure that?
Beyond an individual bullish attitude. So to be clear, we're sweeping out the user's sort of average bullishness with the individual's fixed effects. So this is someone who's bullish on this stock, sort of relative to their average bullishness, is the way to interpret the regression evidence. It's nice. There may be some other ways to try to pick at that, but it's I think there's an interesting idea.
Okay, when a declared bull gives a bearish tweet, what happens to his or her following?
I don't know, but that's an interesting idea. We've heard a version of that question in brown bags, but it's something that we haven't focused on that type of. The question's a little bit different than the type of question that we're looking at, in the sense that that you're sort of asking more about the supply of bullish versus bearish information, whereas I think we're thinking about this more as what's the demands. We're sort of looking at like someone's choices of someone who has declared bull versus bear. We haven't sort of looked at people who've changed their mind and how that filters through. Feels a bit, it's interesting, but it feels a bit different than the type of evidence that we're providing. Wouldn't necessarily provide evidence on or against selective exposure to sort of see really anything with that, I think. But it's an interesting sort of thing to think about for sure.
Okay, Tony, one last question came in. Are your results stronger in any specific industry sector?
Don't know. We haven't looked at industry splits. I think that'd be interesting to do. StockTwits tends to be kind of a lot focused on either big firms, pharma, or tech, and so it's not going to be a representative sample of industries. But it would be interesting to sort of look to see if there's look at this by industry, maybe a version of the stock level bullish versus bearish echo chambers, but by industry. That's a great idea. Thank you.
Okay, that's all the questions.
Okay, great. So first question got me to jump right into the heterogeneity. We're going to do 2 heterogeneity tests. The first one, kind of already previewed this, is that having more investor experience seems to attenuate a bit the degree of selective exposure. I sort of like that experience seems to water down the degree of selective exposure. I think that sort of points to the idea that this could be a psychological phenomenon. That it could be that they're confirming their priors. The other thing to note is that there still is selective exposure that's significant among the professional subsample. So we think that's important to note. And one reason that's important to note is that you might think that maybe more market activity, that StockTwits is mostly a sideshow, but more market activity would be more likely to behave more like the professionals on StockTwits than the novices. So it's useful that the phenomenon that we're seeing is still present among the professionals on the platform. Sort of related to this, we also did this interaction between active user versus not. So if you post above the median number of messages versus below, and what we find is actually people who are more active tend to be more echo chambery. They exhibit about twice the echo chamber. It's still true that people below the median exhibit significant echo chambers. You can see by the baseline coefficient. So we can see that it's present in all samples, but there is some interesting and informative heterogeneity in the tests. Beyond this, more of a classical perspective, you think of the sort of the disagreement literature, you might ask the question, well, does the arrival of news affect this selective exposure behavior? It turns out that sort of consistent with this idea that the disagreement arises around these times where we see information arrive, we actually see more selective exposure on extreme news days. This is as parallels, but is not the same as the Candle and Pearson result, which shows that there's more trading volume around earnings announcements. They actually show that analysts update their on observing the same public signal, they update their forecasts about these firms, their assessments of these firms in sort of differential ways. And so they document a differential interpretation. What we're seeing is differential selective exposure on these extreme news days. So number one, if you just kind of interact on an earnings announcement day, you see nearly twice the amount of selective exposure. Number two, you can split this by bulls versus bears. And you can see that both bulls and bears seem to exhibit more selective exposure on earnings announcement days. And then number three, the third result, which is I think kind of interesting because it's not as symmetric, is that if we look at on earnings days, and we just run the regression for earnings days, but include a dummy for positive news for the earnings day, and so the baseline being negative news, what we see is that there's more positive earnings news leads to more of a bullish echo chamber and doesn't really have an effect on the bearish echo chamber. So I thought this was interesting in that there's kind of two bits. We sort of know that information is going to arrive. You see people selectively and differentially expose themselves to information that comports with their sort of previously stated beliefs. And then when that's robust whether you're bull versus bear, but only on the earnings announcement days, what we're seeing is that the bullish individuals are more responsive to the content of the news than are the bearish individuals. And we thought that was an interesting interesting asymmetry. Okay, so I think we kind of answered a lot of the questions there. I've got about 15 minutes left, so I wanted to sort of dig into some of the details. I know I have the pictures of the organizers here prompting questions, but I want to show you how this relates to trading volume and how we take this idea of selective exposure on StockTwits and boil it down into something that we can then relate to trading volume. So first, I want to sort of point out that this idea of echo chambers leads to this related notion of information silos. So simplest way is to think of in a world without echo chambers, just random connections. There's a distribution of signals that people see. You can see it here, half bull, half bear. And if there aren't any echo chambers, what you see is each individual's newsfeed is going to look like a representative sample drawn from the distribution of original signals. It's going to be a world without any clustering of opinions. With selective exposure, on the other hand, if you believe the evidence we have on echo chambers, you also, the implication is that you'll see clustering of same sentiment signals within receivers. So if you look at individual one who happens to be a bear, that individual is going to see more bearish, disproportionately more bearish news. Individuals 2 and 3 are bulls, and they tend to see disproportionately bullish news, and so on and so forth. You see this clustering of same signals within the newsfeed. This has two implications. One is if you look at this dispersion of opinion that's seen within a newsfeed, it's going to be really concentrated. The other is if you look across newsfeeds, it's going to be more dispersed. And so those two aspects that I just described are the hallmarks of what we call an information silo. And we're going to then relate those notions of information siloing to how much trading goes on in these stocks. So this is what we find. This idea of sort of clustering, what we do is we formally test this in whether there actually is more clustering in StockTwits than you would predict. And so what we can do is you can say, well, okay, here, kind of given the original signals, so there were 4 bearish and 2 bullish, and we saw a receiver who received 2 signals. Well, how likely is it that in that situation you would see sort of all the same signals? You can do the combinatorics, and you can see that that calculation is 47% that you would see all bullish or all bearish. But if instead, if we look at all the situations where about a stock there were 4 bullish, 2 bearish, and individuals saw 2 signals, and we kind of average across that and see the empirical frequency, and we saw that 60% of the time they were all the same messages, well, that would be evidence of information clustering. And that would look like that would be evidence of information siloing. We do this and we sort of bin this to show this in a plot. No information siloing would just be sort of along the 45-degree line. You can see that kind of regardless of sort of the likelihood, the overall likelihood, the likelihood, the empirical frequency of same sentiment messages is significantly above the 45-degree line. And so there's more clustering than you would predict than just making random connections, which is another sort of notion of we can see that this echo chamber behavior that we saw through the following actually does lead to sort of clustering of opinion that people see. Now, our question sort of is, well, does this then, like with this notion of information siloing, well, does that then lead to or really relate to trading in the actual market? If it does, we think that's going to be sort of another sort of piece of evidence that this notion of echo chambers that we're observing on StockTwits is not just happening on StockTwits, but it's relevant for financial markets as well. So kind of reinterpreting some of my recent work with Marina, we looked at disagreement. We did more than just look at sort of disagreement. We sort of decomposed it in a couple of ways. But we looked at disagreement as stated opinions about a stock on a particular day. In this paper, the way we're going to interpret that is that this is disagreement of the sender's signals. So we call this sender disagreement to distinguish it from these notions of information siloing that we're going to sort of look at in the context of trading. So what we'll do is we'll relate received disagreement. So how does my average sentiment in my newsfeed differ from other newsfeeds, a standard deviation across the average signal of the newsfeeds, versus and received uncertainty. How precise is our newsfeeds on average? These two capture sort of different notions of this information siloing. And you might also think, well, these also probably relate to the overall disagreement itself. So they're actually conditional on the level of sender disagreement. We actually have a prediction that received disagreement will be even greater when there's more of an echo chamber, and received uncertainty will be smaller when there's more of an echo chamber. And so that's precisely our prediction. So when we see these information silos, that is high received disagreement and low received uncertainty, we're going to see more trading volume. So just kind of make sure that we have the measurement down. What we do is we take bulls and bears, and as was standard in Antweiler and Frank, we convert these into numbers. We could then compute the standard deviation of these statements of opinion about the stock, and that gives us our sender disagreement measure. What we can do is we could sort of say, okay, here's what non-siloed information would look like, kind of harkening back to that previous slide. You can see that the mean is pretty similar across news feeds. Within standard deviation is pretty big. On the other hand, if what you do is you cluster the information, put all the bearish messages are being followed, are being sent to sort of bearish receivers, and the bullish ones to bullish receivers, what you see is that the means of sentiment are pretty different across the news feeds, but the standard deviation within is very small. That's what we call siloed information. So just a little intuition, I'll show the result with trading volume. Wall Street Journal and New York Times could write different takes. We think that looks about like sender disagreement. As more people read only the Wall Street Journal or the New York Times, kind of selectively exposing themselves to information, that is the implication that people's news feeds become more different from one another. It's higher received disagreement, and more internally consistent. That's sort of less received uncertainty. And if you kind of have more or less received uncertainty, that's from sort of a heuristic perspective, that feels like it's going to make you more confident, maybe more trading. So the question is, well, does this affect trading? So when we look at this, what we do is we run a regression of abnormal log volume on sender disagreement, lagged abnormal log volume, and a bunch of controls. Really doesn't matter how we specify it. We've done it a couple of different ways, but we wanted to bring it really close to sort of my prior work with Marina. Our main result is just the first column replicates the result from my paper with Marina. The only difference is that we're using a sort of a different sample frame. We have 1,000 stocks in this sample, or 900 stocks. Versus in the paper with Marina, we focused on the top 100, but we qualitatively get the same result as we did there. The thing that we're adding here is that when we look at received disagreement and received uncertainty, we get this prediction that those two components of the information siloing lead to or associate strongly with more trading volume. In particular, columns 4 and 5 are the ones that we like, where they include all three. We can see that conditional on the amount of sender disagreement, received disagreement is associated with approximately the same amount of additional abnormal trading volume. And it's about a 4% of the mean of the dependent variable effect. Using effect in a sort of non-causal but hopefully still informative way. Received uncertainty, as you become more certain, that is, as received uncertainty declines, you see more trading volume. That is also consistent with this information siloing having a link with the trading volume. We control flexibly for sort of how much attention is being paid to these stocks using message number fixed effects, month stock fixed effects. This stuff is very really actually robust in terms of the coefficient magnitude. So we think that this is a really actually tight link between this idea that we are seeing on StockTwits and what we see in terms of daily trading volume that happens in the marketplace. So really that's the last result that we have. In conclusion, we find strong evidence that bulls versus bears choose to receive information that confirms their views. We think that's surprising given the pretty strong null in financial markets. People have an incentive to pay attention to value relevant information, maybe not all value relevant information, but the information that exceeds the cost of acquiring it. And that's not true in other settings where people have seen selective exposure. So we think this is interesting and helpful evidence on this. And I think that last result showing that information siloing seems to be important for trading volume is the thing that kind of helps hold this together, is that it's not just the sideshow on StockTwits, but the phenomena that we're seeing on StockTwits seems to actually translate into market behaviors as well. So I think I've left some time, for like 5 minutes for questions.
Tony, there are a couple questions that came in the last few minutes. If you'd like to take those now, or
great, I'd love to.
Okay, can you provide the economic magnitude of the main results? Your dependent variable is a dummy variable whose unconditional mean would be around 50%. What does 1 on the declared bull coefficient mean? Second, instead of a dummy variable for more bull than bear, what about the fraction of bull versus the fraction of bear given a declared bull?
Yeah, so the economic magnitude I think it was probably relating to this specification where you see 1, that's 1%. It's not so this is sweeping out a lot of the variation, but if you look at the unconditional mean of how likely someone is to follow more bull than bear, 1% is about 40% of the baseline probability. So we think that's actually a pretty significant economic magnitude. So thanks for the chance to point that out.
Yeah, and I guess the second was, have you thought about using the fraction bull versus bear instead of a dummy variable?
So we've used a lot of different versions of this, like the newsfeed stuff. We looked at the number of messages rather than do you see more bullish messages versus bearish. We just wanted to make this a bit more robust to people posting or following a bunch of individuals. Yeah, fraction would be a fine robustness, but yeah, but we haven't. I don't know if we've done that particular one, but we've done a lot of different versions of it, and they all end up looking the same in terms of the qualitative big picture story.
Okay, another question. From your early examples, it seemed that some tweets might be more informative than others. Does that matter? Should they be weighed on information content?
That'd be interesting. I think that'd be an interesting heterogeneity test. But yeah, I think we were just sort of pointing out that there were informative tweets out there. Classifying what's informative versus what's not sounds like it has a lot of subjective choices to it, but it might be an interesting thing to do.
Okay, finally, is information siloing also related to potential stock mispricing, idiosyncratic volatility, or abnormal returns?
We haven't looked at those yet, but I think it'd be interesting. I think the abnormal returns and mispricing would be particularly interesting because I think it would help us know if what is the cost. You sort of expect that this is a sort of a costly behavior because people aren't sort of originates out of selective exposure. So we think that it may be valuable to provide some information on that end.
Okay, another question. If a rational person wanted to collect information given limited attention, she would choose to follow people who give valuable information. How can she identify who these people are? She could decide that they give good advice if their position aligns with her position. Is this irrational behavior? Maybe you are identifying the mechanism investors are using to pay attention to all value relevant information as you suggest in your null.
No, so I think that'd be an interesting. I mean, I think still that people are exposing themselves to selectively exposing on the basis of their prior. Is this better information quality versus worse? Maybe we could provide some evidence on the quality of information, whether it predicts returns. That might be a useful way to go. Yeah, I mean it is I mean I think until we sort of go beyond and say like, look, this looks like it's probably has a cost. I mean, I think that my intuition is that it is a costly behavior, but that is a relevant alternative that I think we're gonna want to think more about how to sort it out. But very, very helpful. Thank you.
Those are all the questions.
Okay. Well, great. Yeah. Thank you, everyone, for the comments. As I mentioned, this was really our one of our first presentations, so we really appreciate the feedback, and we'll work on improving the paper. Great. Thanks.
Okay, great. I'd just like to thank Tony for his great presentation. For those of you who participated and asked questions, just wanted to remind you that next Tuesday, May 19th, again at 1 p.m., we're going to have Paige Wime present her paper, Mergers and Acquisitions, Technological Change and Inequality. We'd love to see you here. Thank you.